I'm going to hand over to my colleague, Jonathan Day.
So panel 3, we're going to look at the picks and shovels. And I think what's interesting, when I was going through some of the Q1 reports that have just come out from various companies across the sort of space that are involved in AI, one of them talked about 5 revolutions. And they listed those revolutions. So the first one, they said, was machines in the 19th century. So that was the first one. And following machines, we had electricity at the turn of the 20th century. After that, we had automation coming later in the 20th century, and then that was followed by digital. And now we're in the era, according to them, of intelligence in 2025. But I think what's interesting when you look back at all of those sort of revolutions, is that they all needed infrastructure. They all needed factories, they all needed power, they all needed the picks and shovels, what we have representing us today. Data centers are a lot more than just connectivity, a lot more than just computing power. It's about not just the chips, it's about power, and there are changing power requirements coming through. It's about cooling, it's about water, as you've heard from one of the other panels. There are lots of different components that go into the data center, about steel, and you'll hear about that as well. So delighted to have a panel here today that can address some of that, and represented by companies who have, I think, some valuations that are also quite attractive and good income streams as well. I think that's important when you're thinking about this sort of picks and shovels investment opportunity. In terms of those Q1 26 results, data centers still going, moving ahead very strongly. I think sort of 30% growth in Q1 was talked about, very strong order backlogs, consistently talked about. The challenge, though, of getting those order backlogs into sales, something, again, you might hear a bit about. Hyperscalers massively increasing their investments. We've heard a lot about that already, which I think is interesting. The shift to 800-volt architecture in power, that's another sort of debate that's moving along in the sector. And it's not just in America, it really is in Europe. Companies calling out France, Germany, the UK as seeing quite a lot of growth. Strong momentum. If you're looking at Eaton, one of the big US suppliers, their backlog growth in electrical global, so that excludes the US, up 78%. So it's still going pretty strongly. So what I'll do is hand over to our panelists. I'm delighted to have, and we've got Claire Mogford, Head of Investor Relations at SEGRO, so giving you the property perspective. We have Isabel Aldahir, who is Principal Analyst at Global Data on the Strategic Intelligence side, to give you more of a top-down view. And then we also have Harry Price, who is Divisional Pre-Construction Director at Severfield, to give you that steel perspective and the construction perspective that we talked about. So I will vacate the podium. Claire, over to you.
Thank you, Jonathan, and good morning, everybody. As Jonathan mentioned, I'm going to talk to you a bit about the real estate opportunity in data centers. But I thought I'd start by just giving a little context for those of you that don't know SEGRO, who our business is, what our background is, because it's very relevant when it comes to the data center opportunity that we see across Europe. So for those of you that don't know us, SEGRO is a FTSE 100 listed company. We're the UK's largest listed REIT. It was actually founded in Slough in West London in 1920, and we focused on industrial and logistics assets for over a century. Slough is now home to Europe's largest hub of data centres, and we've got a very exciting data centre opportunity ahead of us, both here in the UK and across our portfolio in continental Europe. Today, we own and manage over 20 billion of assets across the UK and 7 other European countries, and we're providing space to over 1,400 customers across a wide range of sectors, including data center operators, but also the supply chains that service those data centers. So this is that portfolio. About half of our asset base is here in the UK, but we also have major positions in Germany, France, Italy, Poland, plus smaller positions in Spain, the Netherlands, and the Czech Republic. About a third of our assets are in big box warehouses, so those warehouses you see along the edges of major motorways doing fulfillment and distribution. But we're differentiated from some of our other logistics peers by our tilt to supply-constrained urban markets. So these are assets around major cities like London, Paris, major German cities as well. In these cities, industrial land is shrinking, but this space is needed to serve increasingly diverse customer bases that are servicing growing cities. And one of those customer bases are data centers. And that demand-supply imbalance in these cities creates very strong rental growth and also a very exciting opportunity for those of us that have land and power in these positions. Our data center portfolio today represents about 8% of our headline rent, and it sits within the urban part of our portfolio. And just one quick note here. Every dot on this map on the right has been chosen for a specific reason. They are markets where we believe there are the most attractive supply-demand dynamics in Europe for both industrial logistics and data centers, and I'll come on a little bit more to that shortly. So what is the real estate opportunity in data centers? There are a number of different markets that I think are relevant here. Our portfolio today is mainly servicing cloud data center providers, and that's still a huge growth opportunity in Europe. Only about 30% of businesses have their IT infrastructure in the cloud today. So as we go on this journey of cloud adoption, as then AI comes through as well, this is a market that's going to be very attractive. Cloud data centers need to be situated on the edges of cities. They need latency, proximity to users so that you get speed of data transfer. And they also like to cluster to provide resilience. And so they cluster in these things called availability zones. And the largest of those in Europe are known as the FLAP-D markets, which are cities like Frankfurt, London, Amsterdam, Paris, and Dublin. And that footprint, as you have seen from the map before, actually overlaps very much with our urban industrial portfolio, which we've been developing over the last 50 to 100 years. The emerging market is the inference AI, the user interface of AI, and this is about how we interact with Copilot in our day-to-day lives, how businesses use Copilot to improve efficiencies and processes. Again, that needs to be in latency-sensitive locations, so it also needs to be around cities. The third opportunity is machine learning AI, which is actually the one you hear a lot of the headlines about. But actually, machine learning data centers don't need to be in supply-constrained markets. They can be in the middle of nowhere. They can be in remote locations where power is more freely available, where land is more freely available. The speed of data transfer isn't as important. We don't think that's as attractive a real estate market. So we're not looking to build machine learning data centers. For us, it's very much about looking for that opportunity in the cloud and in the inference AI market. So some background to SEGRO's data center portfolio. We've actually been active in this space for over 20 years now. We signed our first lease in Slough in 2005. We've now got over 30 data centers in Slough. As I mentioned, it's Europe's largest hub of data centers. And these have all been built as powered shells. So we effectively build the four walls, the roof. More recently, we started to build multi-story data centers, and that's very attractive because you're then able to charge a higher rent because you're giving a greater power allocation, but over multi-story. So we've got examples where we've taken the rent from a £700,000 industrial development rent to a 10 million rent on the same plot of land. So there's a huge amount of income and value that you can create as you convert, if you can get the power, as you convert these industrial estates into data centers. And you can see at the bottom some of our customers today. So Equinix, Vertus, CyrusOne, Digital Realty, all of the major co-locators, often backed by hyperscalers. So in a lot of this space, there will be Microsoft, Google, etc. as a customer. So what does it need to build a data center for a cloud or an inference AI use case? You need proximity. As I mentioned, you need latency, so you need to be close to major populations and financial centers. You need power. The Slough Trading Estate actually has its own private power network, which is part of the reason why we've been able to grow it so quickly. There was a power station on site, which we've actually sold, but when we sold it, we had a reserved amount of power, which has allowed us to bring through these data centers at pace over the last 20 years. And power is one of the key constraints as you look across Europe right now. Grids have been underinvested. It's not about the power itself, it's how you get that power on site. It's about the grid connections. And if you're starting from scratch today, you're probably waiting 10 years to get a grid connection. So if you've been in this space for longer, you have a first mover advantage if you have that power pipeline. And the final element is planning, which is particularly tricky in cities like London and Paris. We've got green belts around the edge of the cities that are fiercely protected. So you need an expertise to be able to navigate this planning environment to bring these through. There are also objections often for environmental reasons or community reasons. But planning is an area where, because of that footprint, because of the period that we've been in this space, actually, if you've got that planning expertise, you can really, it creates a barrier to entry to others, but it's a competitive advantage for you. And in Slough in particular, we have a very unique situation. We have a simplified planning zone, which gives us a 10-year master plan of pre-approved planning. So if we want to bring a data centre forward, we give the Borough Council 2 weeks' notice and we can start on site. So if you can get that sort of planning environment in your favour, then it's very attractive, because it takes others sometimes 2-3 years to get planning at the moment. So that's what you need for the real estate. That's what makes an attractive data centre market. This is what we've developed. So we've taken what we've learned in Slough and we've applied that across our portfolio. And we have power and land in all of the dots in the map on the right. You can see it aligns with our urban industrial footprint. It covers some of those flat D markets that I mentioned, as well as some of the emerging markets. And we have a pipeline of 2.5 gigawatts of power coming through over the next decade, which will allow us to bring forward schemes in many of these major markets. And we have a market-leading operating platform that is going to allow us to execute this on through the development and the planning. So another note on the real estate solutions, there are different models that you can follow if you want to unlock the opportunity in real estate. One of the most simplest is getting the land, getting the power, and then selling it to a hyperscaler to develop it themselves. We have done that. We will do that on certain sites, but you are getting a one-off profit rather than getting a long-term income stream. The second model is the powered shell, which we've done very successfully in Slough for over 20 years. We're building the shell, we're giving the customer some power, and then they're fitting out the data center with all of the M&E equipment, bringing in the racks, etc., and operating it themselves. More recently, we've moved into the fully fitted model. So this is a newer emerging model, I would say. We're not looking to operate data centers. We are a real estate player, and we think that is where our strength lies. But we think there's an opportunity to invest some more capital into the fit out of these data centers, to put in very long lifespan equipment like backup generators, cooling systems, and potentially be able to get more profit, create more value on that asset, but then lease it to a customer who will operate it and maintain it themselves. And so this is the new, more emerging opportunity to play data centers in the real estate space, I would say. We will do this through JVs with experienced operators that have expertise in fitting out. And we have announced our first one last year. We've just received planning for it, and we're hoping to sign a lease for that data center by the end of this year, which will be our first fully fitted. And then we will replicate that model across other markets. So in summary, in terms of the real estate opportunity in data centers, I think SEGRO has an exceptional position in Europe, probably almost an unmatched position when you take into account the power, land, and planning positions that we have. We've got the ability to drive significant value through these sites, whether that's through selling the land, the powered shell, or the fully fitted approach on certain sites. We intend to execute it in sequence and to co-invest with joint venture partners so that we can self-fund the balance sheet, self-fund the development program rather than needing to raise huge amounts of equity to capitalize on it. And we'll be leveraging the expertise of our industrial and logistics established platform to help build out that opportunity and to grow the opportunity. So this isn't a one-off, it's something that we intend to keep adding to, and it will become a flywheel.
Thank you, Claire. Great. So now we're coming probably off the ground a little bit, I would say, and going to more of a top-down strategic view of the sort of picks and shovels and the backdrop. Delighted to introduce Isabel Aldair, who is Principal Analyst at Global Data, to talk about the AI infrastructure. Isabel.
All right, hello everyone. As Jonathan said, my name is Isabel Aldair. I'm a principal analyst in the Strategic Intelligence Division of Global Data, where I lead much of our coverage on emerging technologies such as AI and also quantum computing, advising our clients on what these disruptive technologies mean for them and what they need to be prepared for. I don't want to spend too long on introductions, but I would like to give you some context as to what we do at Global Data. So Global Data is an intelligence and productivity platform headquartered in London with offices around the world. Our London office is very near here, near Blackfriars. We have hundreds of analysts covering all the major sectors, as you see behind me, over 20 in total. In the Strategic Intelligence Division specifically, we look at the major themes and technologies that are impacting our clients across those many sectors, trying to provide the best foresight that we can as to how we see things evolving. When it comes to hyperscalers, as we're here to discuss today, we have analysts covering this from numerous different perspectives and angles, from AI, of course, and digital transformation, including cybersecurity and quantum computing, to geopolitics, which is leading to greater and greater emphasis on digital sovereignty, both from a software development perspective, but also from the hardware engineering and manufacturing, all the way through to energy transition, of course, as we ask ourselves the very often repeated question, how are we going to power all of this? So many, many interlocking themes, and if any of these particularly speak to you, then please come talk to me after the session as well. So here we have a breakdown of the broad elements that make up the AI ecosystem, both software and hardware. And with colleagues at Global Data, we've been discussing which of these categories or elements are best positioned to see growth. And we've come to the conclusion that on the software side, it's the SaaS companies, the software as a service companies, and the cloud service providers that are particularly well positioned. The SaaS companies, obviously, they sit quite close to where the user workflow is, where the AI value is easiest to capture at the application layer. Often these softwares are already very well embedded within enterprise processes. So adding AI features, particularly agentic, changes the conventional user workflow from user-driven to AI-driven, but it is a natural upgrade, and it's not hard to sell because the foundation has already been sold. Same for the cloud service providers, whether it's a hyperscaler planning or optimizing for the next 10 to 15 years, or a neo-cloud pursuing a more short-term opportunistic business model, both are very well positioned right now. On the other hand, system integrators, as was discussed in the 10 a.m. session, system integrators are in a little bit of a trickier position. A lot of their market is being eroded thanks to the AI-ready softwares that are being produced by the SaaS companies. The LLM developers as well, they now have their own consultancy arms, so OpenAI and Anthropic, they have their own consultancy arms that help with deployment and integration. So some of those customers that might have once gone to system integrators now can circumvent that need. Anyway, I know the focus today is on the hardware, so I won't speak more about the software, but obviously tremendous growth across the hardware and both the chips and the data center facilities and equipment. And again, at Global Data, we've broken down the data center capex across these different categories. And it's about a 50-50 split. So about 50% is going towards the electronics, so the CPUs, the memory, the networking, GPUs. And then the remaining 50% is going towards the land, the building construction, the cooling, the power distribution, fire management. So this is how it looks now. We are anticipating some changes in this chart. So for example, we are expecting the CPU share to increase. GPUs are, of course, necessary for all the parallel processing and matrix multiplications that are computed every time an LLM is prompted. But for agentic workloads, these are really CPU-based. AI agents, they're operating, or they're conducting a rapid series of steps that make up sequential execution cycles, and these workloads are CPU-based. And so anybody following Intel and AMD stocks will have seen them rebound quite successfully on the back of this renewed recognition of CPUs. So where in the, the pre-agentic era, there might have been a ratio of about 7 GPUs to 1 CPU. Now, in the agentic era, we're tending more and more so towards a 1-to-1 procurement ratio. That being said, there's quite a large cost differential. So a GPU would cost around 40 to 50K individually. Meanwhile, a CPU, a very high-end one, is a maximum 10K, so quite a large cost difference. The remaining share, the 48% that's encircled, is, like I said, going towards the construction, so the land, the buildings, the cooling, the power distribution. And there is a lot of challenges here, of course. So with rack densities or the power densities going into hundreds of kilowatts, we're moving more and more towards liquid cooling requirements. It's almost imperative now. Traditional air cooling, it reaches its limits at about 30 to 40 kilowatts, and now, of course, we're exceeding 100 kilowatts. And that presents its own complexities and cost issues. In the power distribution segment, also, again, a lot of challenges here. There are incredibly long lead times on very important equipment, like switchgears and transformers. And the problem with this is that the equipment is often bespoke. It's custom to each project. So it's very difficult to fulfill orders in advance. And so although manufacturing supply is there are attempts to increase manufacturing supply, it's a bit like a dog chasing its tail as AI demand keeps going up. And this is leading to compounding delays and shortages. And there's some reports that about 50% of US data center projects are being either delayed or indefinitely paused because of these constraints. And so where is all this demand coming from? As you can imagine, it's coming from the hyperscalers, much of it. I'm sure many of you have seen similar or variations of this chart estimating the amount of spend on, by various hyperscalers on AI and AI infrastructure. When I presented this a couple of months ago, it looked a little bit different because the amount has actually increased since then, about 20-30 billion across this group. So who knows where or what the sums will be at the end of 2026, but certainly it will be an unprecedented amount and it gives rise to a lot of discussion. So I'll wrap up here, but like I said, please do contact us at Global Data or do find me after the session as well if you'd like a longer conversation. But with that, I'll hand back to Jonathan.
Thank you, Isabel. Yeah, that hyperscaler capex, as you say, is there's no knowing quite where it's going to end. I mean, Eaton in the US were pointing out that you're up to $3 trillion in North America of mega projects at the moment. In fact, that was a Q4 stat, and they didn't update it, I don't think, for Q1. But as they see it, only 15% of that's been executed so far. Hence, you're starting to see some of these sort of bottlenecks, unsurprisingly, sort of creep in. And that brings us sort of back down to earth a little bit and allows me to hand over to our third panel speaker, Harry. Delighted to introduce Harry from Severfield, Harry Price, who's going to talk a bit more about the sort of steel angle and the construction side from Severfield.
Afternoon, everybody. So my name's Harry Price, and just before I move on from this, we've been talking about the proliferation of AI around people's offices, businesses, how they're integrating it. And my first one-to-one this morning kindly told me that my photo looked like if someone asked ChatGPT what it would look like if I could still grow hair. So we'll move swiftly on from that. So I am, perhaps sort of strangely for a day like this, I'm not from the finance side of our business. I'm very much operational, so I'm our major projects pre-construction director. So I look after essentially all of the work-winning activities for anything that we deem a major project, which, as you can imagine, with the sort of the numbers we're talking about and the sort of the capex going on in the sort of data center market at the moment, a lot of these projects would sort of come under my remit. They are some pretty major projects. Oh no. That slide is meant to animate really nicely and cover lots of different sort of financial bits and bobs. Unfortunately it doesn't, so I will just sort of give you a few headline bits about Severfield. So we are the UK's largest structural steelwork fabricator. So at the moment, sort of current turnover, which you can't see there, it's sort of one of the numbers at the back, we're about sort of just under 500 million, and that in sort of steel terms equates as a group to 300,000 tonnes a year. So the way we operate as a group, we operate across UK and Europe, across 7 manufacturing facilities. So our UK and Europe capacity is about 150,000 tonnes, and then we have a 50% of a joint venture in India, which focuses really on the Indian domestic market, and that again has a capacity of about 150,000 tonnes. So that, as a metric, probably doesn't mean much now. I'll sort of come back to that in a later slide on what sort of a ton of steel looks like and how that feels in the context of the capex and talking about potential bottlenecks, sort of, etc. So So where we work, as I've just covered, United Kingdom, Europe, India. Again, from a data center perspective, sort of echoing what Claire's just talked about from SEGRO's sort of pipeline and the assets that they manage. A huge amount of data center work for us at the moment is in the Nordics, is in continental Europe and the Nordics from a cooling perspective, from a green energy perspective. But a lot of the work that's been undertaken there is through UK supply chain. So a lot of the main contractors, general contractors over there are UK and Ireland, a lot of the steelwork. So we do have domestic competition in continental Europe, but there's a strong showing from the UK construction sector over there. India, it's an emerging market really for us, and it just shows the scale of the place that our Indian business already equals our capacity in the UK and Europe, and that's just dipping a toe. People don't really want to build out of steel. It's still very much a concrete country, but that's already got sort of huge growth potential. So again, what you would see is lots of pretty pictures sort of scrolling down there, but excuse the animation's not working. But this is just a snapshot really of the sectors that we operate in. So I know we're all here today predominantly to talk about the data center market. So this is sort of everything but data centers. So for some of the reasons we'll probably come on to in the panel discussion and pipeline and the timing of it, we are, as a business, deliberately sector agnostic. We almost have to be. We are a manufacturing business. It's not manufacturing widgets. You're not making single components. Structural steelwork is a very bespoke world. Everything is, to suit a particular building in a particular use case. So the main thing for us as a business is managing that fabrication capacity. We have a huge capacity to be able to do 150,000 tons. If you're not constantly feeding that mouth, keeping it busy, it gets very difficult. So when projects are potentially in delay or things take a little while to come to market for planning reasons or power availability, we need to operate in multiple sectors to keep that business going, so distribution plays a huge part of that. Again, similarly with SEGRO, Stadia and Leisure, we do a lot of London commercial work. So we're quite a diverse business and operate pretty much in every sector available. I think another one that would fly by there is nuclear and defence. Obviously, the UK PLC, that's a huge growth market at the moment. So data centres. So just to put a little bit of context around from our perspective as a business, some of the capex numbers that we'll be talking about. At the moment, there are circa 120, just over, data centre schemes currently at varying stages through the UK sort of planning process. Now, obviously, all of varying sizes. Some of those are quite small. Some of the big hyperscalers, the gigawatt, sort of gigawatt campuses. So for context, a multiple building, sort of multiple data hall, gigawatt data center campus in the UK will be just over 100,000 tons of structural steelwork. So for context, Wembley Stadium was about 23,000 tons. The Shard, which was one of ours, was 12,000 tons. So if you imagine something that's roughly one of these gigawatt data center campuses is roughly 9 or 10 times the volumetric sort of measure of steel that's in the Shard. So there's a huge demand there. There's some big numbers. And again, for context of that 100,000 tons in 1 gigawatt campus, the UK forecast from our industry body, so the British Constructional Steelwork Association, the market forecast for 2026 is that the UK will use 873,000 tons of structural steelwork. So that's across all products, all sectors, the market as a whole. Now, again, for a little bit more context, of that 873,000 tons, there are, round numbers, 90 of us in the UK, 90 fabricators of varying sizes. So a mean average doesn't mean much because there's some of us that are quite large, some of us that are quite small, but that's about just shy of 5,000 tons per fabricator in the UK that will draw down from that overall UK demand. So if you think of that as the mean size of a UK steelwork business, and then the potential demand of 120 data centres through planning, that rough numbers, if you look at the overall size, that's about 5 million tonnes of steel across those jobs in the next 5 to 10 years. So there we go, paint a little bit of a picture for you. So in terms of the general market overview and where we sort of sit in that and what's going on, again, there'll be lots of nice sort of pretty projects scaling through there that will give you a snapshot of things that we're on site with at the moment, but there's a few there. So a few London commercial jobs, and that's Old Oak Common Station that's in the middle, one of the sort of flagship HS2 stations. So quite well publicised, you know, especially in the UK. As a consumer, steel is a very political animal. You know, you'll have seen just over the last 24 or 48 hours the plan to bring British Steel back into public ownership. So again, when you look at a business, you look at steel work, it's quite an emotive thing. People talk about build with British Steel. Construction plays a very small part in steel manufacturing. You know, if you look at the output from British Steel, white goods, yellow goods, and rail by far dwarf construction demand. So I think that's me hitting a microphone there, sorry. You know, construction plays quite a small part in the overall demand. So there's a lot of political posturing at the moment. A lot of that is around defence capability, and construction wants green steel. UK defence needs dirty steel because you can't make armoured plate from recycled steel. So there's a lot at play that will sort of impact the UK's construction capacity and ability to sort of meet all of the potential demand. So again, to availability of low carbon materials, I don't know if anyone's seen, but in the UK government steel strategy, there's a potential dramatically reduced quota on steel coming into the UK from the EU, which is where the vast majority of low carbon materials come from. So there's been quite a lot of lobbying from our industry body back to the UK government, so that decision's been postponed slightly, but you know, there's a few things at play, which on the flip side of that, there's a strong pipeline in distribution, strong pipeline in data centres. London commercial is waking back up. You know, London's very cyclical. It's on the uptick at the moment. There's a lot of large towers in planning. There's a lot of large tower jobs that are hitting the tender process now. So the way we're seeing that as a... I don't think that was me this time. The way we're seeing that come to fruition in the marketplace is a lot of clients are moving away from traditional building tender processes, and you know, you look at say a hyperscaler, traditionally clients like that would go to a SEGO developer, and then that would go to a normal tender process and just filter through into the supply chain. When something like say the steel frame or sort of groundworks packages, the major packages in building out these big projects, we're seeing an uptick in developer-led sort of procurement. So a lot of the jobs, if you're looking to get capacity you want to build one of these gigawatt data centers, you need to, when these projects go, they go. Clients expect things to get built very, very quickly. They want to get the equipment turned on as quickly as possible. So we're seeing a lot more client-led negotiation being brought on board a lot earlier, people to guarantee capacity and sort of impact the supply chain in that way. So there's ways and means of, you know, not to steal Jonathan's thunder and answer any of the questions before they're asked, but there's ways and means of navigating these bottlenecks and how as a construction sector as a whole in the UK we meet this demand and do it as efficiently as possible and as quickly as possible. So that's a very brief, hopefully, snapshot of Severfield as a business and where we fit in this whole picture. We won't go to lunch and networking. I will hand back to Jonathan and answer some questions. Thank you.
Fantastic. Thank you, Harry. Yeah, thank you to all our presenters. I think 3 sort of excellent presentations. We're going to throw it open to Q&A. I'm conscious there's still a little bit of time for Q&A before I hand back to Fraser, and then for some closing remarks and then some lunch. So would anyone like to kick off, or if you like, I can kick off with one. Yes.
On the situation with the capex cycle, right, which is exciting and short-term, is amazing numbers. You know, in terms of the business, the way you plan the business, for example, in your case or what duration do you give this cycle? You know, I mean, this is basically different from the one in 1990 to 2000 when we started building data centers. So what sort of, in terms of how you plan your business, how long will it take? And when will be peak capex in your mind?
Yeah, Claire, do you want to start?
Yeah, I think there's very big numbers out there in the headlines. I think And it's still not clear where that capex gets spent. A lot of it, I think, goes into these gigawatt factories, machine learning. That cycle, I think, is harder to anticipate. But what I would say is that the cloud market, for example, and the inference AI market, we think that's a very long-term, very resilient driver of demand. Cloud is expected to forecast to grow in Europe between 15 and 20% per annum over the next 5 to 10 years, depending on whose numbers that you look at. So I think we're probably taking a more conservative approach when it comes to the real estate solutions by investing in that market that we think has got the really enduring long-term demand. And things like European business putting their IT infrastructure into the cloud, that's only going one way. And so we try and anticipate it like that. I mean, we'll be doing all of our development pre-let, so we're not going to be speccing data centers, hoping that the demand comes. The demand will come from the co-locators, from the hyperscalers, and so that will allow us to pace it. But I mean, our pipeline we see being a 10-year opportunity for us, and we will bring it through in phases depending on when that power comes online and when that demand comes online.
From our perspective, we have to make strategic views as a business on where we want to spend our time and focus our energy on where the potential sort of growth markets are and that sort of side of it. But realistically for us, we also have to keep an eye on, it's a viability game. These projects have to be real. So we try not to get too excited by, say $660 billion of spend. When you look at the UK, aside from Europe, the UK is a very slow-moving market. So of all of the projects going through planning, there are only about 7% of those that are actually real projects at the moment, compared to, I've got my stats here, 46% in Germany, 40% in France, 25% in the US. So the UK is really lagging behind to quote the name of the session, you're getting the spades in the ground. It's just not happening. So we can't look at any sort of capacity and reserve anything in goodwill. We can only respond to what's physically in the market that's out there that we can tender for and hopefully secure, which I get to my earlier point is why we have to be so sector agnostic. We have to keep a focus spread on where the work is. And that's where what we're trying to do now is have a lot more mature conversations with not just our direct employers, our general contractors typically, but from a business development and relationship perspective, we have to have relationships all the way up the zipper, if you like, to try and understand what's coming down the pipe in 5 years, 10 years, so we can at least have those conversations and make sure that the business is ready for what might come. So it's sort of very much a dual approach, really, of what's real and in front of us and what else we're tracking and seeing coming down the road.
Okay. Isabel, anything you want to add?
Oh no, I think we sit too far outside the supply chain analysis.
Fantastic. Any other questions? Yes. Sorry, there's a microphone just coming. Sorry.
Thank you all for your presentations. My question is for Harry. Where do you see, we'll say, the price of steel and maybe inflation with respect to steel? Or do you see shortages in that market? Thank you.
It's a difficult one. I mean, in terms of raw material prices, we had a long period of stability as a sector. Post-Ukraine, it's been a bit of a roller coaster. The Ukrainian conflict was the first that really sort of absolutely skyrocketed. We saw 300 or 400% increases in raw material costs, which did settle, that softened back down. The actual cost of steel, I say it doesn't impact us. It's a pass-through cost for us, really. The impact is it's more the knock-on effect of scheme viability. So steel has its sort of per ton cost. We price on that basis. It's passed through to end clients. It's at what point does that become intolerable to a developer and they'll turn the tap off. Away from steel, obviously cost of living has been a big cost increase for the market as a whole. Skilled labour shortages in the UK have steadily crept up labour costs. So costs of construction have increased year on year. But there's, as a business, we do as much as we can to mitigate that through training, efficiency, and all that sort of good stuff. But ultimately, raw material costs, it's anyone's guess at the moment with the sort of the geopolitical climate out there.
Yeah, I think when you look at the sort of reporting that's just been coming through for Q1, people are alluding to a whole set of pressures on costs. Some of it's of raw material, tariffs, elements of supply chain, labour costs also going up as well. There's quite a bit of sort of cost inflation out there, and then I think there's still a debate about how quickly some of that comes through the system. Any other questions? Yes, on the aisle. Yeah, the mic's just behind you. There we go.
Thank you very much for all the speakers. Perhaps this is one for Harry. What happens if this capacity doesn't come into the UK and we fail to build that capacity? What happens?
What happens? Things don't get built. I don't know. I mean, it's a difficult one because if you look at the overall market capacity, say in Europe, like I said earlier, a lot of that is UK businesses over there. I think people just have to look elsewhere, essentially. I mean, what we try to do as a business is compete in a global market in the UK. I mean, you'll see pretty well publicised that Net Z0 on Teesside has placed the first meaningful order the UK seen for Chinese fabricated materials, which has caused a political stir, as you can imagine. So ultimately, like with any market, it's incumbent on us to be as competitive as we can in the domestic market that we serve. I don't particularly foresee a position where the market is so hot that UK capacity can't meet it. I personally, it's so hard to see, but when you look at these, say there's 5 million tonnes of steel coming down the pipe in 5 or 10 years, whether that will actually hit or not, I don't see. You know, we've been in this position before with the UK market with London Commercial or say Football Stadium or at the start of HS2. You know, there was similar talking at the start of the HS2 build out that the UK couldn't possibly meet the demand that was going to be placed on it, but then the build-out programs softened to such a point that it has, you know, reasonably comfortable. There's a number of bridges in the UK that have come from overseas. There's some of our European competitors did a few of the bridge projects, but honest answer, I don't know if that happens. I don't know what happens. Fabricated steelwork or any sort of construction product it's a commodity market essentially, and the global economy will flex to suit that need, but the hope would certainly be that I don't think that UK demand would outstrip the possible supply. I mean, for context, I mentioned our industry body just in steel thinks the market will be 873,000 tonnes this year. We peaked in the UK at just over 1.2. So businesses have, you know, we went from 1.2 and came back down to about 680 in the 2008 crash, and that was an overnight sort of bang. A lot of businesses lost their capacity and went under. It then gone back up, and it's steadily crept down. So there's still a lot of latent, I would suggest there's quite a lot of latent supply capacity in the UK to meet flexing demands. But what actually comes to markets, ultimately anybody's guess at the time that things land on people's desks, really, when they get through planning and get funding and it's a scheme ready to go. So sorry, that's not an actual answer, but you know.
Brilliant, thank you. Any other questions? Maybe I can just sort of pitch in with one. Perhaps you can sort of talk a bit about some of the changing requirements that you're seeing across the sort of data center space from customers in terms of footprint, size, technology. You mentioned some cooling. Just interested to hear how it's evolving and how quickly, I guess, it's evolving.
Sure, I can start off. I think I would expect that it's the cooling technology that's changing perhaps the most, moving towards the liquid cooling. I can't remember if I mentioned this during my presentation, but I saw a presentation by Vertiv saying that they're predicting 100% liquid cooling very soon because of such high power densities in the compute racks. And then I suppose, you know, which liquid cooling method are you going to use? The different types. It's more fragmented than the traditional air cooling, which was much more standardized or unified. And there's a bit of a trade-off between thermal efficiency, integration complexity, and various other metrics. Some methods like immersion cooling, they're relatively immature, but they have very good performance metrics, but it's difficult. And I think the problem is that with shortages and delays happening and compounding the problem, your initial data center spec might become partially obsolete over time. And so what you think you might need, because AI workloads are changing, the demands are changing, the power requirements are changing, the cooling infrastructure you might think you need today might not be the same as 1 year from now. And this is quite a problem.
Yeah, I mean, it's something that it's one of the reasons why we want to pre-let, to be honest, because if you pre-let to the customer and you've already agreed that spec and you've signed a contract on that basis, then that's what you deliver. I think it's quite a dangerous game speccing things at the moment, especially when it comes to fit out, because you don't know ultimately what the customer is going to want by the time you deliver this, because it's a 3-year time frame to deliver a fully fitted data center. So it's something we're very mindful of. It's a reason why, rather than building a fully fitted data center for the first time ourselves, we're doing it with a partner that's got a lot of experience in this space, a lot of experience in sourcing this equipment. But I think the pre-letting is really key for us to just make sure that we've removed any of that risk. Interestingly, I was on site in Slough last week meeting one of our customers who's actually in the data center supply chain, and they do the rack technology for the hyperscalers. So we're the fully fitted data center, you'll put in the backup generators, the cooling system, but we're not putting in chips and servers and racks. That still is the premise of the end customer, the hyperscaler. And so they've tripled the amount of space they've taken with us over the last 18 months because they can't keep up with demand. And they were telling us that the rack technology, although a rack in theory lasts for 5 years, they're seeing hyperscalers change them out every year. So that was quite interesting, the GPU piece on your graph actually makes it, the magnitude of the spend in those racks just is mind-blowing. And one of those single racks, I think they said, was millions. It was fascinating. So it's the only thing we do know is it's going to change quickly, but we have to try and manage that when it comes to the risks that we're taking, which is why we've chosen the models that we have.
Yeah.
I mean, from our point, we're sort of painfully aware that our job is the very sort of uncultured bit of keeping the clever stuff dry and supported. You know, we don't impact that much on the technology. What we are seeing though is clients taking a far more whole life cycle view on building design. So, you know, ESG targets remain stringent, and the way we've seen a lot of people meet, say, embodied carbon and cost requirements in a building is to go as light as possible, to keep everything as efficient as possible, which, you know, is engineering, it makes sense. What we're seeing, particularly across data centers, we've done a lot in the UK of car battery plants and high-tech manufacturing facilities, is that the equipment that's going in these buildings is iterating so quickly, in some cases getting lighter, in a lot of cases getting a lot heavier, that we're advising clients where we're involved in the building design and the framing typology to build redundancy in. Might not make sense from an efficiency perspective now to build something that's capable of holding far more than you actually want it to, but it's going to be a hell of a lot cheaper and more carbon efficient now to build something that can support equipment that might weigh a server rack that might weigh 50% more than the current model, just so that you're not going back to the drawing board and redoing a new building or strengthening something up. So we're seeing a bit of a maturity in the design conversations that are going on for these buildings that, like Claire said, look, it might be in a year's time, the contents of this building look dramatically different to what we're planning now. And I think especially back to the bottleneck conversation, when you look at how long it's taking a project in the UK or in sort of the Nordics or wherever to go through the planning process, tender process, to physically get something, break ground on site and hand something over, that's like a 2 or 3 year window. The technology, when you start that process compared to when you actually sort of switch the thing on, is dramatically different. It's growing so quickly. So there's just a lot of redundancy now that needs to be considered as part of the whole life cycle cost of a building.
Brilliant. Thank you. Well, I'm conscious of time. I think you've heard some good stories this morning. Thank you very much to all of you for attending the session and for the questions. And obviously, thank you very much to our 3 presenters. as I said at the start, it's not over yet. Delighted to hand back to Fraser for closing remarks. Fraser.
Thank you, Jonathan. Right, well, just so we don't break it up into two different breakup sessions, just leaves it for me to say, listen, a very, very big thank you to all of you for taking time to listen today, for the panel, the speakers, and for the team at Edison for organising such a wonderful event. This is very much now becoming a part of the established London conference timetable, and we very much look forward to, well, maybe Danielle and Pip don't, but the event for next year. And I wonder, I guess there's a couple of things as to, whether in a year's time the Straits of Hormuz will be open, I don't know. Will Starmer still be in power? I don't know. Will Polar Tech be up another 50%? I don't know. But I suspect that we probably still will be talking about AI and how it's impacting our lives. So big thank you. There is lunch, an opportunity still to network and chat to everybody and the speakers. So with that, I will close the sessions and let you all go and have some refreshments. Thank you very much.